Hello, everyone. You may have been hearing something in the financial press of some sort of concern coming up in March, and I'm speaking about what was in today's Financial Times, and it was written by John Dizzard. And here's a quote: "Market freezes have a way of happening in March and September, an echo of the crop cycle." Now, we've talked about this on this show before, and Jeff, you've written about it in your work going back to 2014, 2015, if I remember correctly. And so people are familiar with this notion about the seasonal low point in liquidity, but some people on Twitter are not. And so here, Daniela Gabor is asking a question. She says, "I don't get the argument here. Why can't longer term bonds be used as collateral?" And she copied in Carolyn Cisco, who knows a few things about these matters. And here's what she replied: long-term bonds have interest rate risk and are inherently riskier collateral than bills. Wondering whether current dynamics related to possible expiration of the SLR relief at the end of March, but most likely it will be extended. If selling predicted yields rise, bills preferred as collateral. It's very hard to read abbreviated Twitter posts. Jeff, we're going to talk about how this whole SLR thing came to pass. We're going to be referencing an article at Real Clear Markets. It's called "Beware, There's Another SLF Cliff Coming at the End of Q1." Jeff, what do you want to tell us?
First of all, that's wrong. It's SLR. That's actually my mistake. I through our heavy editorial processes, these typos. I think there's actually two of them actually stayed in the article, and they're right in the introduction too. So that's kind of embarrassing. But it's the SLR, supplementary leverage ratio.
Let's start at the beginning, Jeff. You could start with Adam and Eve. It's up to you. We've got the time. Or you can start with Bankhaus Herstatt.
Well, I don't think we should start with Adam and Eve because that kind of gets too many broad range of topics. So we're really talking, if we're going to work toward the SLR cliff, this potential cliff, that's really a Basel rule. And so I think, where did the Basel rules come from? And they actually came from this episode that happened in June of 1974 with as you pointed out, a mid-level German bank that was heavily operating in something called the Eurodollar market.
And as you say, they were taking in Eurodollar deposits and arbitraging the spread between offshore and New York dollar markets. Before I go on, Jeff, does that mean that back then interest rates were capped in America, but dollars didn't exist just in America? They existed around the world. They were available around the world, and interest rates were higher elsewhere because there was no government saying you can't pay more interest on that. And so, does that mean that this bank was trying to get money out of the U.S. or creating money abroad and arbitraging the spread between the two? Is that what was happening?
Yep, they did a lot of that. Plus, they also were hugely important in developing the forward currency markets, which meant that, okay, you want to borrow funds from me to 3 months from now. I don't really have any dollars for you, but I promise to obtain them on your behalf at this specified price. So that creates all sorts of currency and rate risk too, because what you're really saying is a German industrial firm that wants to, buy some raw material from Brazil or someplace 3 months from now is going to need the dollars to do it. You're promising you have a hard contract to deliver those dollars, which really means that maybe I can get them from internal processes and deliver them then, but more than likely I'm going to be able to go into the Eurodollar market and be able to borrow them at a rate that I think that I can be able to borrow them at. So a forward currency market is essentially extending the efficiency as well as the fungibility of these global dollars into different qualitative dimensions.
And so the forward market is over-the-counter, bespoke, and importantly, it's not on a futures exchange whereby there's some middle person, middle entity that is requiring some sort of collateral to be put up, right? And so this bank was going into the Eurodollar market, and it came to the attention of regulators in Germany and in Britain who said,
They said, "Hey,
seems
you've got a hell of a lot of U.S.
yeah.
dollar liabilities.
What's
you're
are you
like
going to make good on this?
right. You're the 80th, the 50th, 60th largest bank in Germany. Why do you have billions of dollars and billions of U.S. dollars in foreign currency liability? Maybe we should be pay attention to you."
And they said, don't worry, we've got important customers in Ruhr who need this. But it turns out that no,
well, they said we've got legitimate business reasons for this because there's a growing globalization, global trend. Germany's at the forefront of selling goods all over the world. They need the dollars to do it. So we have legitimate demand for our dollar activities. But they also said, which may have been a lie, may have been fraud, that we've covered our currency risk through other, offsetting dimensions with other dealers in the London Eurodollar market. That was really the point of contention, was had they really managed their risks?
And now, folks, we're going to tie it back to last week's episode with Real Clear Markets, where we discussed chips and interbank clearing and daylight overdraft. So, Jeff, very interesting how these things happen, right? The bank, Herstatt, had a correspondent relationship with Chase Manhattan Bank in New York City. And the location is important because the earth spins around at this kind of pace. And in London, daylight times go out faster. So it's this timing, this daylight overdraft. And tell us the story about the regulators coming in, closing down the bank in Germany, and how all of a sudden, the books aren't closed. Your intraday activity is at risk.
Yeah, well, first of all, Herstatt had covered its foreign currency liabilities. It hadn't. By early June of 1974, regulators had later noticed that their U.S. dollar liabilities had exploded against them, which essentially created all sorts of losses. I think it was something over the order of $500 million Deutschmarks worth of losses that nobody could really cover. So the bank needed to be taken over and put into receivership. Well, on that particular day, I believe it was June 26, 1974, the German regulators, as maybe German regulators in the 1970s acted, they took a rather leisurely approach to the thing. They said there was something in the record about a traffic jam delaying officials getting to the conference room. Somebody had a late flight. But either way, they had a late start on their voting decision to close down Bankhaus Herstatt. And so they didn't come to a decision until the end of the day, which in Germany they thought, well, it's the end of the German trading. What's the purpose, or what's the big deal? So they closed down. They issued the order to close it down, and I believe it was 4:30 in the afternoon there, which was 10:30 in the morning in New York. So you're Chase Manhattan. You have a correspondent relationship with Herstatt. The day has already started, as we talked about with chips. There's messages going back and forth, and so Chase Manhattan is accumulating payment liabilities. Essentially, Herstatt is accumulating a daylight overdraft. At the same time, it's already closed in the middle of the New York day.
Over liability. So people are saying, hey, Chase, Herstatt's owes me money. And Chase says, all right. And so Chase should be sending money to them. And then they would, at the end of the day, turn around
sending dollars on Herstatt's behalf to people who are claiming, I need to get paid from, whatever from Herstatt. And Chase would do that. Say, at the end of the day, when the chips day close, we settle up with Herstatt when everybody's happy. But if Herstatt is no longer in business, there is no settlement at the end of the day.
Whose money is
quickly realized, oh, wait a minute, I'm on the hook. So what they did is they stopped all outgoing payments on Herstatt's behalf while still collecting incoming receipts, trying to build up their own liquidity cushion, because at that time in the middle of 1974, it wasn't really clear how this was going to work, because we have a German bank being taken over in Germany. Which bankruptcy rules apply? And although there were several court cases that ended up coming out of this, along with some other bank failures in the fall of 1974, where it was as clear as mud how this was going to go. And one of the judges in one of those bankruptcy cases says, if we look at bankruptcy in terms of equitable redistribution of resources, then time isn't a factor. Well, I hate that, time is absolutely a factor when you're talking about chips and intraday and overnight drafts and things like that, or daylight drafts, because that's really what's going on here. And quite literally in the case of Herstatt, what became called Herstatt risk is we have to pay attention to time zones, because we now have a global monetary system.
Fascinating, fascinating. And so our friends at CHIPS, the Clearinghouse Interbank Payment System, said, you know what, we don't quite like this. And so they came up with an idea about a recall and a clawback. And I'm going to read this out because it's kind of confusing. I don't quite understand how this works. Let me read it out. So within a week of Herstatt's closing, the settling members, New York Clearinghouse Association, had introduced a recall provision into CHIPS that would allow them to claw back funds from foreign respondents up to 10 a.m. New York time the following day. What?
Yeah, it was just so that we need to account for time differences. So something ever happens again, transactions that we thought we settled yesterday, we have the unilateral ability to say, no, we didn't settle them yesterday. I need those funds back. And as you can surmise, that kind of violates the whole principle of, real-time gross settlement mechanisms, which is when we settle, we settle. That's the end of the story. And we need to be able to count on that. It needs to be that predictable. And so as a consequence of this recall provision, which is nothing more than the Clearinghouse Association trying to protect its members from getting stuck into Chase's situation, because I believe it was Chase said, look, we have maybe as much as $600 million in potential losses here if we can't get the funds back from Herstatt out of bankruptcy. At that time, $600 million was an enormous sum, especially for a single correspondent relationship. And so, what happened over the next couple of days into spilling over into early July 1974 was that the entire Eurodollar market itself sort of ground to a halt. Interest rates rose, illiquidity, non-negotiable, forward market completely shut down, all because the settlement, somebody threw a wrench into an unanticipated wrench based on nothing more than time zones into this interbank settlement processing system.
It's just fascinating. I love these stories. It's amazing how fragile the system is. But you don't want to keep it fragile.
That's an important point that I didn't make in the article that I think I should make here is that, remember, this is not a system that somebody sat down and said, I'm going to carefully design all the elements of it. This is a thrown together, an organic ad hoc system that just got put together by necessity because, quote unquote, benign neglect was the official policy. The banking system was left to figure out how to solve all of these issues that really needed to be solved, because the Eurodollar, not the dollar, had become the global reserve currency, the mechanism for distributing liquidity that's primary role of a global reserve currency. And it was really just kind of thrown together. Nobody really thought about these things. They were just alpha and beta testing it as it was going, because what else were they going to do? And so they came up upon this one problem that they didn't think was a problem.
Well, the regulators got involved, the governments got involved, the central bankers got involved, and they said, we need to do something. And I'm not surprised that it's the Bank of England that is leading the charge here. This seems to be the only one of the few banks that admits to the existence of the Eurodollar system for obvious reasons, which we won't get into right now. But the point is, they said, we need to come up with an early warning system. And they came up with two that you discuss here. Tell us what the two ideas were. The first one.
Well, back in the 70s, first of all, I think there was more of an appreciation for how important this Eurodollar system had become. Because it was easier to see, because it was we're at the leading edge of the second wave of globalization in the 70s and 80s. So they understood that this was really important stuff. This offshore dollar market had become the central pivot point for lots of business all over the world. The world financial system and the world economy was becoming more interconnected, and it was becoming more interconnected through this Eurodollar channel. So anything that threatened the Eurodollar channel was the same as the Suez crisis in '56. If you close down the Suez Canal, yeah, business can still happen, global trade can still happen, but it's much more expensive, much more inefficient. So the Bank of England in particular, but also the Bank of France and other central banks in Europe said, we might want to look at this, because although it worked out well, they settled their differences and figured out how they were going to manage this Herstatt risk going forward. What if it was bigger than that? What if it was not just some mid-level German forward currency trader? What if it was one of the big guys? There's some real risk here. And besides, more for the point, this offshore Eurodollar system isn't covered by any regulations anywhere. So they were saying, look, we don't say in public that this is potentially a problem, but it's potentially a problem.
And so they said, they couldn't quite figure out how to measure if a bank was at risk. So the first suggestion was, why don't we have an informal, I know this isn't a chat network, and
that's exactly what they came up with.
A messenger.
As asinine or ludicrous as it sounds, George Blunden, who was the head of supervision for the Bank of England, said, we need to develop an early warning system. We have to be able to, remember, I'm in England, Herstatt's in Germany. I have no way as head of supervision of the Bank of England to supervise Bankhaus Herstatt. But I need to be able to do that because it does have consequences. And we all want to be able to do that. Now, we want to preserve sovereignty, national regulatory structure. So what we're really proposing is cooperation amongst regulators to try to develop an early warning system so that we can see these things happening before they become major problems. And what they said was, well, what we really want to know is, what are these guys doing? We need to hear trader gossip. We need the traders down on the floor who talk all the time. The traders are they're infamous gossips. And so all we need is to create a channel where that gossip can filter up to regulators and sovereign central banks and things like that so that we can maybe create a system where we can develop this early warning system. So, Herstatt, I hear the chatter in New York from Chase Manhattan's guys that they're doing stuff they probably shouldn't be doing. We need to take a closer look at that. Or we need to tap the regulators in Germany on the shoulder and say, you guys need to take a closer look at Herstatt. Even though that's what already happened. That's exactly what happened in the years before Herstatt's failure. They thought we need to formalize the structure and make it better. But essentially the early warning system was, we need the system to tell us what's going on because it's that complicated, it's that intricate, and it takes place in the shadows.
Now, eventually they migrated to something a little bit more objective. I don't know if that's even the right word. Seemingly objective. And that is the birth. And where were they meeting, Jeff? They were meeting in Basel.
Blunden was the chairperson of this informal committee that met in Basel, Switzerland. So this is the precursor to the Basel Accords, because after a couple of years of trying to create this gossipy-based early warning system, they threw up their hands and said, it's just not flying, and nor would it. I mean, the idea was sound, but you're never going to have traders running to their local regulators saying, hey, the guy that I'm doing business with and making a lot of money with, he's doing things that are, the way we're making a lot of money doing business is something you need to take a look at, right? That's just not going to happen. So it wasn't the idea itself that was flawed, is that there was no realistic way to get the system to identify risks to regulators. And so regulators said at this Basel committee, well, what else could we possibly do? I know. We'll come up with some objective way to quantitatively describe bank activities, taking a particular focus on these international banks and what they're doing between each other, but not just international banks. And that's why the Basel Accords became these international bank standards, or not really standards, but recommended standards, because they decided, well, we can't have a gossip-based early warning system, but maybe through capital ratios, getting banks to file with us and describe their own activities to us, and we'll create a standardized number, these capital ratios and other kinds of metrics. We'll be able to have an early warning system because we'll see changes in these numbers that will identify for us all of the risks that had gone unnoticed beforehand.
What sort of warning were regulators given from the capital ratios being reported by Bear Stearns and Lehman Brothers?
Yeah, none, right? Because Bear Stearns and Lehman Brothers had absolutely sterling capital ratios when they failed, or when Bear Stearns was forced into merger with J.P. Morgan. As it turned out, banks grew very adept at essentially manipulating their capital ratios, using all sorts of derivatives and other types of things, and
all legal.
Yeah, well, actually, within the letter of every law, there was no laws broken. I mean, some of the stuff that came out later. But as far as general management of capital ratios, not just at Lehman Brothers and Bear Stearns, but Citigroup and everybody else, everything they had done was legitimate within the rules. It's just that they had hired, an army of lobbyists, accountants, and attorneys to make sure what exactly can we get away with in these rules. And what they identified primarily was essentially credit default swaps, which provided them regulatory capital relief in a lot of ways. They could increase this leverage on their balance sheet that would not show up in a capital ratio. So the capital ratios had a blind spot, which, going back to George Blunden, would have been filled in had they figured out a way to develop this gossip system.
It reminds me a little bit about Enron. Enron was following the accounting standards, not to the spirit, but to the letter. But it was the spirit that they were violating, and that's what mattered. And so thereafter, what did we have? We had the Sarbanes-Oxley that was implemented. And in the financial world, we had something implemented, I believe it's called the SLR, Supplementary Leverage Ratio. And it's kind of weird. It's because now it's like the roles are reversed. Now the SLR is the problem instead of warning regulators to a problem within a bank. The SLR is the problem.
A lot of people say it's the problem that regulations in the post-crisis era. Let's be clear. The SLR came out after 2008, long after 2008. And it was a way that the Basel people decided, well, how do we fix the capital ratios in their blind spot? How do we do that? And so what they said was, we won't let banks risk weight their assets or give them the opportunity to manipulate the risk bucket their assets go into. So we'll just measure their balance sheet as it is, nominally, in absolute terms. And that's really what the supplementary leverage ratio is. It's what did Bear Stearns look like, not in terms of its capital ratio, but its SLR ratio, which you would have seen as massive amounts of leverage. And so maybe this is a better way of developing early warning system. But when we do that, obviously the banking system itself can't do all the stuff the banking system used to do before 2007 without incurring capital charges, as well as supplementary charges that are added on for globally or systemically important financial institutions. And so a lot of people have said these regulations are onerous, they're balance sheet restrictive, and that's the reason why the dealer banks have all shrunk over the last couple of years, or more than a couple of years, over the last 10 years.
14.
Because regulations have made banking too expensive. And I don't think that's really the case at all, because if you go back to the Herstatt episode, that was a big potential problem that was solved relatively quickly, and not by regulators. It was solved quickly because everyone had a vested interest in this system getting bigger and working and all these other things. What's really happened is that behavior has changed, and that's the reason why the gossip system would have worked the best, because that's really what we want to know. We want to know a banking system's behavior, and you don't really get that from these static ratios. And so we look at the banking system behavior post-crisis, long before the SLR was ever developed, long before Dodd-Frank. Dodd-Frank didn't show up until years after the crisis. Banking system behavior changed as early as 2007 because it looked at all of these risks, and banks decided, we don't want to be the next Bear Stearns. We don't want to be Lehman Brothers. The Fed looks at Bear Stearns as a success because it didn't, they shepherded what seemed to be a disruptive failure into the waiting arms of JP Morgan. But if you're the management of Bear Stearns or you're the employees of Bear Stearns, that wasn't a good episode for you. So nobody wants to be Bear Stearns. You don't want to be the next one, even if the Fed takes a positive view of that outcome. For the participants in the system, that was a negative impact. So behavior had already changed beforehand. So we fast forward to today, we have this SLR cliff, which we'll explain in a minute, which shouldn't be a problem, because banks if their behavior says we're willing to take on risks, it doesn't matter what the cost is. We'll do it because we think it's worth the effort. And so if there is an SLR cliff, or people think the SLR is a problem, it's only because this behavioral change is behind everything. We don't think it's worth us trying to overcome, surmount it, or just pay the surcharges, because there's opportunity out there in the real economy globally.
Very well stated, Jeff. And as I've often said, the entire Eurodollar system was in response to the restrictions. Straitjacket restrictions, financial repression restrictions that make this SLR stuff look like child's play. But the system grew because there was money to be made. Take us out of here, Jeff. What is this concern about a cliff coming up maybe at the end of March? Should we be concerned? The Financial Times, Mr. Deiser says.
Last May, the Federal Reserve and the OCC and the FDIC got together and said, for American banks, we're not going to count US Treasuries nor deposit balances held at the Federal Reserve, bank reserves. We're not going to count these two assets when calculating SLRs up until March 31st of 2021. So essentially, it was a free period for banks to be able to absorb U.S. Treasuries, which were being sold by the bushel and to be able to continue to hold on to bank reserves, which were going to be created by the Federal Reserve and its quantitative easing and other quote unquote accommodative policies. But as I said, that was only a temporary abatement. And March 31st, 2021, all the treasuries that banks have bought over the last 9 months, 10 months, whatever it's been, along with all of the elevated level of bank reserves that are going to be transferred out of the TGA as Janet Yellen goes into her refunding stuff and stimulus gets spent and whatever. So we have this possibility that for the SLR calculations, a lot more assets are going to be added to them than had been previously, which will make banks more expensive, their balance sheets more expensive than they had been, higher capital charges and things like that, which some people are worried that will cause some banks to do other things to try to lighten the SLR load. And among other things they might do is sell treasuries, long end treasuries. If you don't need them, as you were pointing out at the start of this segment, maybe that's one reason why the treasury market is sold off. If treasuries are going to suddenly be counted, better to have long end, or better to sell the long stuff that have inflation risk or perceived inflation risk from some people, and hold on to treasury bills, because those at least have high utility in the repo market, the highest of the highest quality. So the idea is that, look, there's a regulatory change coming up on March 31st that might cause all sorts of unintended consequences.
Well, we shall see what happens then, Jeff. I really enjoyed it. I think we've covered everything. If not, let me know. Otherwise, we'll move on to discussing the American consumer. Oh, okay. So we will move on to the American consumer. Super. Okay.